The Fed has officially started a new round of interest rate cuts. Given the current economic stability and lack of recession signs, this can be seen as a precautionary rate cut cycle. What is our view on managing various assets during this precautionary rate cut? For U.S. stocks, the month following a rate cut is often a critical window for gains due to increased liquidity and higher valuations. However, different types of rate cut cycles diverge after that. Over the long term, precautionary cuts favor equities. Fourth, in a soft landing of the U.S. economy, equities tend to rise significantly during precautionary cuts. This will further lower corporate financing costs and improve profitability. For U.S. Treasuries, they typically react quickly to rate cut cycles. Due to expectations of economic and rate declines, Treasury prices tend to rise quickly before rate cuts, but gains may narrow 1 to 2 months after cuts. Especially during precautionary cuts, stronger economic fundamentals can somewhat suppress bond market performance. On the contrary, U.S. bonds perform better in a recession with lower interest rates. The dollar often declines with negative data, but economic fundamentals may support its strength. For example, in 2014 the rate cut led to a soft landing, with a strong economy but unstable dollar index. So how will various assets trade after this rate cut? For U.S. stocks, we believe small cap growth may outperform the large cap market. On one hand, lower rates relieve short-term debt pressure on small firms, boosting profit expectations and valuations. On the other hand, a soft landing boosts sentiment for mid and small caps amid rate cuts. Small cap growth, driven by Russell 2000, had returns of 1.8%, 12.1%, and 47.7% in May, December, and 3 months post-rate cut, outpacing S&P 500's 2.3%, 7.3%, and 10.7%, 7%. However, there are concerns regarding the tech sector. The main concern is that tech companies in deleveraging hold a lot of cash, so the impact of interest rate cuts on their refinancing is minimal. Tech stocks, led by Nvidia, may see deleveraging again. From a sentiment perspective, though the tech giants have been the most crowded trade, bullish sentiment has weakened from 70% in July to below 50% in September. It is expected that U.S. Treasury yields will decline in the short term but later rebound. U.S. Treasury rates are the most sensitive to interest rate cycles. Reviewing the rate cuts since 1994, the 10-year Treasury yield has shown a clear decline. After rate cuts take effect, if previous expectations were too high, the 10-year Treasury yield declined significantly, lacking short-term downward momentum. However, with the ongoing slowdown or potential recession in the U.S. economy, there is still considerable room for Treasury yields to drop. The dollar may fall in the short term but the decline will be limited, as it often drops during rate cut cycles. However, considering the strong fundamentals of the U.S. economy, and the relatively stronger European economy compared to China, the dollar's decline may be somewhat limited. Commodity prices are influenced by global economic growth and the depreciation of the dollar, with foreign-priced commodities like oil expected to rise. For processed materials, due to factors like the sluggish real estate market, gold is viewed neutrally and can be passively allocated. Regarding asset investment and allocation, we believe there are challenges for individual investors. We recommend choosing professional institutions that can provide you with objective analysis and advice.